Investing is like learning a new language. To succeed, you need to understand the language of business, and that's where financial statements come in. These statements are the report cards of companies, providing a glimpse into their financial health and performance. As an investor, reading and understanding these statements are crucial for making informed decisions. Think of it like this. You wouldn't buy a house without inspecting its foundation, plumbing, and electrical systems. Similarly, you shouldn't invest in a company without examining its financial statements. They tell you how a company generates revenue, manages expenses, and utilizes its assets. By mastering the art of reading financial statements, you gain a significant advantage in the market. You can identify undervalued companies, spot potential risks, and make smarter investment choices. In the following sections, we'll delve into the three major financial statements: the balance sheet, income statement, and cash flow statement, and explore how to interpret them effectively. Understanding these statements empowers you to invest with confidence, making decisions based on facts and figures rather than speculation. So, let's embark on this journey of financial literacy and unlock the secrets hidden within these powerful documents. The balance sheet is a snapshot of a company's financial health at a specific moment in time. It shows what a company owns, assets, what it owes, liabilities, and the owner's stake, equity. Assets are categorized into current and non-current. Current assets can be converted into cash within a year. Non-current assets are long-term investments like property and equipment. Liabilities represent a company's obligations. Current liabilities are due within a year. Non-current liabilities are long-term obligations. Equity is the owner's claim after liabilities are paid off. The balance sheet follows the equation: assets equals liabilities plus equity. The income statement, also known as the profit and loss statement, provides a summary of a company's financial performance over a specific period. It shows how much revenue a company generated, the expenses incurred in earning that revenue, and the resulting profit or loss. The income statement starts with revenue, which is the income generated from selling goods or services. From revenue, we subtract the cost of goods sold, which represents the direct costs associated with producing those goods or services. This gives us the gross profit. Next, we deduct operating expenses, such as salaries, rent, and marketing expenses, from the gross profit to arrive at the operating income. Operating income reflects the profit generated from a company's core business operations. Finally, we subtract non-operating expenses, such as interest expenses and taxes, to arrive at the net income or net profit. Net income represents the bottom line, showing the actual profit available to shareholders after all expenses are paid. Analyzing the income statement helps you understand a company's profitability trends, its ability to control costs, and its overall operational efficiency. It also provides insights into how well a company is managing its expenses to generate profits. The cash flow statement tracks the movement of cash both into and out of a company over a specific period. It provides a clear picture of a company's cash inflows and outflows, which is essential for understanding its financial health. The cash flow statement is divided into three sections: operating activities, investing activities, and financing activities. Cash flow from operating activities reflects the cash generated or used in a company's day-to-day operations. This includes cash received from customers, cash paid to suppliers, and cash paid for operating expenses. Cash flow from investing activities shows the cash flow related to a company's investments. This includes the purchase or sale of long-term assets like property, plant, and equipment, as well as investments in other companies. Cash flow from financing activities reflects the cash flow related to a company's financing. This includes cash received from issuing stock or debt and cash used to repay debt or pay dividends to shareholders. Analyzing the cash flow statement helps you understand how a company generates and uses its cash, which is crucial for assessing its short-term and long-term liquidity. It also provides insights into a company's ability to generate cash from its operations, invest in its growth, and meet its financial obligations. Section 5. Financial ratios, the keys to unlocking insights. Financial ratios are powerful tools that help you analyze and interpret financial statements more effectively. These ratios provide a standardized way to compare a company's financial performance against its own historical data, industry averages, or competitors. There are numerous financial ratios, but some of the key categories include liquidity ratios, solvency ratios, profitability ratios, and efficiency ratios. Liquidity ratios measure a company's ability to meet its short-term obligations. Some common liquidity ratios include the current ratio and the quick ratio. Solvency ratios assess a company's ability to meet its long-term obligations. Examples include the debt-to-equity ratio and the times interest earned ratio. Profitability ratios measure a company's profitability. Common profitability ratios include the gross profit margin, operating profit margin, and net profit margin. Efficiency ratios measure how efficiently a company utilizes its assets. Examples include the inventory turnover ratio and the asset turnover ratio. By calculating and analyzing these ratios, you can gain deeper insights into a company's financial health, profitability, and efficiency. Remember that no single ratio tells the whole story, so it's crucial to consider multiple ratios in conjunction with other fundamental analysis tools. Section 6. Combining fundamental and technical analysis, a powerful investment strategy. While fundamental analysis, which involves analyzing financial statements, provides a solid foundation for investment decisions, it's equally important to consider technical analysis. Technical analysis involves studying price charts and trading volumes to identify patterns and trends that can indicate future price movements. Technical analysis can help you identify entry and exit points for your investments, manage risk by setting stop-loss orders, and confirm trends identified through fundamental analysis. However, it's important to note that technical analysis should not be used in isolation, but rather as a complement to your fundamental analysis. By combining fundamental and technical analysis, you can create a robust investment strategy that balances a deep understanding of a company's financials with an awareness of market sentiment and price trends. This holistic approach can significantly improve your chances of making profitable investment decisions. Remember, investing is not an exact science, and there is no foolproof method for guaranteed success. However, by combining thorough fundamental analysis with the insights gained from technical analysis, you can significantly increase your odds of making informed and profitable investment decisions. Section 7. Real-world examples. Insights from industry giants. Let's illustrate financial statement analysis with examples from Reliance Industries, Infosys, and HDFC Bank. Reliance Industries maintains a strong balance sheet with healthy liquidity and solvency ratios. Infosys boasts impressive profitability ratios and consistent revenue growth. HDFC Bank maintains high asset quality and strong capital adequacy ratios. Analyzing these giants' financials offers insights into their business models and future prospects. Practical tips for beginner investors. Start with the basics. Understand the fundamental components of each financial statement. Focus on what each line item represents and look for trends. Analyze data over several years to identify trends. Compare with industry peers to understand performance. Utilize online resources and seek professional advice if needed. Mastering financial statement analysis is a continuous learning process. Section 9. Conclusion. Empowering investment decisions. In the world of investing, knowledge is power. By mastering the language of business and learning to decipher the information hidden within financial statements, you empower yourself to make informed investment decisions based on facts and figures, not speculation. Remember, investing is not about getting rich quick, but rather about building long-term wealth through careful analysis, disciplined decision-making, and a commitment to continuous learning. As you delve deeper into the world of financial statements, you'll discover a treasure trove of information that can guide your investment journey and help you achieve your financial goals. So, embrace the power of financial literacy. Equip yourself with the knowledge to analyze companies and embark on your investment journey with confidence. The ability to read and understand financial statements is a valuable skill that will serve you well throughout your investing life.